Hello, everyone. Welcome back, and it's David Shih here. I'm here to give you a quick update on the September finance and lending side of things, just to give everyone a bit of update on that. As a lot of people have been asking me what's been happening around the lending environment. So I thought we'll do a quick segment in terms of just a monthly update on what I'm seeing and what the property investors should be aware of in terms of the changes that could impact you. Okay, so first of all, let's do a quick market segment update. And in terms of the sentiment, as we all know that September is the third month in which RBA has now paused the rate hike. So at the moment, the market is starting to bounce back in terms of the buyer interest at the moment. And also due to the fixed rate roll-off, we're seeing a lot more stock that's coming up as well at the moment. I believe it's about 10 to 20% year on year at the moment. So there's definitely a lot more investors at the moment that's currently in the process of sell-off due to their ultra low fixed rate has now expired and rolling off onto a 6 point something percent investment P&I or interest only rate, which means, the cash flow is now very, very negative. So on that basis, that's why I think we're seeing a lot of investors started to sell off, in particular Sydney and Melbourne market segments. Okay, so that's definitely what's currently happening. But having said that, we're not seeing any softening at the moment in terms of the property prices. I mean, there's definitely a lot more stock available at the moment, and it's started to get absorbed as well. So I think it just depends on which market you're looking at right now. In a few months' time, we might start to see a bit more softening in terms of the prices, but we're still early days at the moment. So that's the market sentiment at the moment. Now, also talk a bit about the lending conditions as well. So most lenders at the moment still abide to the 3% assessment rate buffer. Now, what does that mean? Basically, what that means is if you're looking at purchasing or refinancing, then the bank is actually going to assess you on the interest rate that you're going to get plus 3% on top of that. So let's say, for example, you're an owner-occupier looking to purchase your first home, and the bank's giving you 6% interest rate on an owner-occ P&I. And what that means is for your borrowing capacity, they will assess it at 6% plus 3% or 9% in terms of your ability to be able to repay the loan. As you can see, that is a very, very high figure. We are probably if at the peak of the current cycle, if not already at the peak of the current interest rate cycle. So using another 3% on top, to me personally, doesn't actually make much sense. But anyway, it is what the APRA or the prudential regulator has been instructing the banks or the ADIs to abide to. So unfortunately, they have to stick with this. So far, that's putting a lot of dent on borrowing capacity. There's still a lot of inquiries in terms of people wanting to buy. However, when they did the servicing check or the borrowing capacity check with me, unfortunately, it's not a favorable result for them. Okay, so purchasers still struggling a lot at the moment in terms of borrowing capacity. There are non-banks, however, which has started to loosen up on that. So non-banks are not abiding by the 3% buffer. They don't have to. So a lot of them has reduced to 2%, some even to 1% for purchases. Okay, so just a very minority of those. So a 2% reduction in terms of the assessment buffer could give you anywhere between a 10 to 15% borrowing capacity boost. So on that basis, that would actually help those people who wants to be able to purchase a property, an extra bit of leg room to be able to allow them to push a little bit higher on that. So if you're someone who is looking to be able to continue grow your portfolio today, then chances are you may have to look at using a non-bank in order to further accumulate your portfolio at this stage. On the refinance market, however, as we all know, like a lot of lenders have now pushed through with the 1% assessment rate buffer. So, this includes pretty much all the major banks at the moment, as well as, some non-majors like Bankwest, for example. So these lenders are now able to allow people, or what we call those mortgage prisoners, so people who have rolled off fixed rate at a 2%, for example, and now rolled off to maybe a 7% or something, if the existing bank is not willing to give them further reduction on the owner-occupier rates or investor rates, then they are basically locked in, as that's what they call mortgage prisoners on that. So the 1% buffer is primarily to help those mortgage prisoners to be able to refinance to a more competitive interest rate. And that's why most of the 1% refinance buffer are designed to refinance to a principal and interest repayment. Okay, so on that basis, that's why it is very, very challenging for anyone who want to be able to use the 1% buffer and refinance to interest only, especially for investor clients. For example, if you're on a Pepper or Liberty, sometimes it can be very, very challenging to still refinance out of those institutions and back into the majors or non-majors in that sense. So unfortunately, not much good news there, but I guess, as more and more lenders started to loosen up and then more and more lenders start to look for ways to be able to improve borrowing capacity, obviously within the realms of the APRA regulators' realms, then, we might see a bit more loosening coming up in the next few months. So far, even the non-banks at the moment is allowing 2% refinance buffer, some of them even allowing 1% as well. So, it might be worthwhile reviewing it and then see where you're standing at, just to get another opinion to see where you stand and how it could further improve on that, especially when we all know right now interest rate is very, very high. So cash flow is definitely taking a hit. So any gains that you can have, that is definitely going to help you. Okay, so that's a quick update on the lending conditions. Also worth noting, in the last few weeks, what we're seeing now is the major bank has started to drop the fixed rates, and we're talking about 1 to 2 years or even 3 years. We're seeing, I think last couple of weeks, Westpac and NAB has already came out reducing the 2 to 3 years fixed rate by maybe around the 0.2 to 0.3%. And the ANZ has also announced earlier this week or late last week that they are also reducing their fixed rate for 2 to 3 years, etc. as well. So it's all by about 0.2, 0.3%. So we're not talking about a significant drop, and the 2 to 3 years fixed rate are still hovering at the moment, still higher than their usual variable rate counter offers, but we're not talking about too much differences now. Now, what does that mean? Generally speaking, the fixed rate indication is what the bank thinks that, in 2 to 3 years' time, where they think the rate would be at that point in time. So let's say, for example, in 2 years' time, the fixed rate is at 6%, whereas beforehand it was at 6.3%. Then what that means is they actually think that in 2 to 3 years' time, the interest rate is going to drop, essentially. Okay, so there could be some reductions in the next 2 to 3 years. So basically, they're being a bit more optimistic in terms of, the short to midterm, to the 2 to 3 years time frame, in that sense, and would allow people, I guess, to consider, if you want certainty, then obviously fixed rate is still a good option at the moment, but most of my clients at the moment are kind of more prefer to stick on variable, just because of that future potential decreases, and we don't know what that and how quickly that cash rate decrease could be in 2024 or even 2025. So, but I thought that was interesting to see that now, the anticipation is starting to come down in terms of dropping the fixed rate, which means, we might be at the peak of the rates already, and there will be a bit more leg room to move, hopefully in the next year or two, on the interest rate reductions. So that's pretty much all I want to cover today. So thank you for tuning in. And as always, if you like to hear anything, or if you got any questions about what I covered today, feel free to reach out or just basically comment below, and I will address them as I can. Have a wonderful week, guys. Chat to you next time.